The settlement deed is the mechanism to create the trust, but it's all rather vanilla legalities,
Yeah.
legalese. The letter of wishes is the bespoke document that reaffirms what the settlers, as they're referred to, want with this settlement.
Welcome to Listen Without Prejudice, your exclusive gateway to one of London's leading law firms. In each episode, we dive deep into the stories, insights, and expertise that make Bishop Sewell a trusted name in the legal community. Join us as we explore everything from the latest legal trends and case studies to practical advice on residential and commercial property, corporate and commercial law, employment, family and divorce matters, private clients, and dispute resolution. Whether you're a legal professional, a client, or simply curious about the law, Listen Without Prejudice is here to inform, inspire, and engage. Now, without further ado, let's get the conversation started.
Good morning, I'm Nicholas Barlow, head of the private client team at Bishop Sewell, and I'm joined today by Ben Williamson, senior associate in the private client team, to talk about our favourite topic, the family trust. Now, Ben, we've been busy over the last few months setting up trusts for clients, and I thought it would be helpful to record a short piece about why we're doing this, who it's for, what are the practicalities involved, and touching, of course, on that old topic of tax and how that will implicate us. So first of all, who's this for? I'm guessing for people in the UK, but perhaps you could give some examples of the clients we've worked with and why this would be of any particular interest.
Oh, a good question. And I suppose it's not a one-job-fits-all, really. Our clients are from various backgrounds and different economy levels, and at times a trust is suitable for all of them. I think it's safe to say they're not always a necessity, and at times they can be quite an administrative burden, but in the right circumstances and the right asset structure, they're a very useful mechanism to, I suppose, as they would say, mitigate tax.
Yes, that's the reputation, I suppose, of trusts being some way of escaping tax. But as we've seen, they are taxed, as with everything else in economic life nowadays. But they can be used, I think, principally for protecting assets as well. So the old reason for having a trust before tax really sort of bit a chunk out of it. So perhaps you could cover some of the asset protection aspects and what a trustee can and cannot do.
Well, they, as you say, they're a wonderful mechanism to safeguard assets, particularly if there are any potential vulnerabilities with any family members. I know it's not necessarily the topic today, but we always consider them as mechanisms to protect assets for those that are more vulnerable in society, whether through mental incapabilities or just vulnerabilities otherwise. They are a wonderful structure.
Or presumably young beneficiaries as well.
Absolutely, yes. Whether minors or young adults that are not necessarily so responsible with their cash at that point.
Yes,
We hear
18 might be a bit young.
Yes, exactly.
Yeah,
I mean,
yeah.
hear a lot of horror stories about going spending all their inheritance, whether through life or on death, to buy the new fancy sports car,
Yes.
the arm and a leg that insurance cost, and maybe living to regret that as they hit 30 with their own children.
Exactly.
So, yeah, the wonderful structure just to safeguard that.
Well, let's talk in particular about the property trusts that we've been preparing recently. So we've had clients speak to us where they might have a second home or a holiday home that they've owned for a number of years and they've got children and grandchildren. So why would a trust be helpful in that situation?
One main part is obviously keeping it in the families for the future generations. A lot of the time we have a lot of families that may be in Dorset or Devon or your obvious locations that they've had the holiday home that they've grown up in and spent fond years there as children, and the grandchildren are starting to enjoy that now, and it's a very sentimental asset for the family.
Yeah.
Upon death, there's this inheritance tax to consider in the UK, and it's not insubstantial, which everyone is aware of. One mechanism is to think about is putting it into a trust.
So how can that help spread the burden of inheritance tax rather than just doing nothing and holding on to it?
Depends on the value, and we really need to think about factors such as what the value of this property is. Anything upwards of 650,000 is a little bit more to think about, but if you've got the holiday home within a £650,000 bracket and you're a married couple, using a trust structure is a sensible way to transfer an asset without paying an immediate inheritance tax charge. And at the same time, provided you are not enjoying it for the entirety of the year, for example, is it a way that will work?
Is that what's called reserving a benefit?
Exactly that. Yes. What you can't do is be putting assets into a trust that you intend to enjoy. So if, for example, you've got a buy-to-let property and you need that income and the prospects of needing it in the foreseeable future or long-term future is likely, these type of structures are not necessarily going to work because of this provision. But, for example, if it's a non-interest accruing asset and it's a holiday home that you may only spend 2 or 3, or maybe 6 weeks a year at, and the rest of the family do use and do enjoy it at other periods of the year, there's a lot of merit in thinking about such a trust.
We've seen situations where those holiday homes, as we all know, have to be kept in good repair and there are expenses associated with that. So can the trustees have a sum of money to help cover those costs, or would that money perhaps be given in the future by the original donors of the asset into the trust?
Absolutely. There's various ways around this. Obviously, trust can hold cash.
Yeah.
And depending on the value again, it might be worth thinking about putting a lump sum in there that can cover the annual cost for the foreseeable. Loans can be provided as well as another option if that's suitable. Or again, thinking long-term and more sensible tax planning, if either of the settlers, thinking combined spouses, have surplus income each year. We can add some surplus income in. It's referred to as a surplus gift out of income. And again, provided it's considered correctly, is another way of putting some money in without a tax charge, which again then could be used to cover future costs for that property.
And we often talk about the 7-year rule and needing to survive gifts by 7 years. Does that apply, or how does that apply in this situation with putting, say, a property into a trust or then putting in surplus income into a trust?
Surplus income is a other topic that is essentially tax-free because it is an exemption which the HMRC allow. In terms of the additional entry, that is subject to this 7-year rule which you hear of. One way to think of it is that provided it's within this nil-rate ban, these £325,000 allowances, even if you didn't survive the 7 years, the argument is you're not going to be worse off. It's just lost from your estate, so the rest of your estate wouldn't have it. But that would still be the same position should you leave it in your name and it's just an asset that's inherited and taxed upon the second death.
And you've mentioned this valuation point. Is that a value that you look up yourself or just get from a local estate agent? What would be the best way of approaching that?
There is always the approach of using local estate agents. I personally think this is a tax valuation. It's a valuation purely for tax purposes. So there is merits in using a formal, what they refer to as a red book chartered surveyor to provide such a valuation. It's more accurate. It's done for tax reasons. So it's what HMRC would expect you to produce. And for that reason is generally why I would recommend it, for that certainty.
And those valuations would take into account the condition of the property rather than perhaps the inflated expectations of a local agent looking for a good commission.
Exactly that. Yeah, this is not a marketing brochure. This is not about presenting the best option available and the best price available. It is a realistic valuation given all the factors. So if there is wear and tear, this property, say, is on the coast and has been battered by the coastal air for several years and it is worn down and needs work, the valuations would consider that and make sure it is a true reflection of what is the accurate valuation for it.
So we've talked about who would want to set up this type of trust and the sort of assets to put in it. Can you just talk through the practicalities? Presumably a document is needed.
Yes, yeah, we refer to it as a settlement deed. That is the foundation really, and essentially what creates this trust. There are various provisions and various terms to think about, which I won't go into in this conversation, but as long as it's produced properly and has the required powers in, it essentially provides whoever you choose to be your trustees with the mechanism to make sure it can be managed and looked after properly, whatever the assets consist of.
And the beneficiaries will be listed in that document. Can you add beneficiaries in the future? Is that a possibility?
Absolutely. Again, provided it's worded correctly, there is the powers there to add beneficiaries. We would normally look at keeping it quite a broad open pool anyway, and most obvious example would be children, future issues, so grandchildren, even great-grandchildren, Sometimes charities can be incorporated into that if clients are minded to do so, and any other beneficiaries. So if there's close uncles and aunts or nieces and nephews, whoever it may be, the pool's quite wide and can be decided by whoever's creating this trust.
That's good. We talked at the beginning about the tax aspects, and this is a situation where there may have been a property that was bought years ago, and so there's a lot of capital gain that has built up, and we saw in the recent budget that capital gains tax has increased. So can you just summarise the capital gains tax position? I believe you can defer the payment of tax even though you've given away an asset.
Absolutely, yes. So what they refer to it as holding over the gain. As you say, this doesn't clear the gain. It just essentially holds it over, so you can put it into the trust without paying that capital gains tax liability. Essentially, the gain will sit there, and depending on what the trustees' decisions are and how they decide and make future decisions about that property, the capital gains tax liability remains. It's just there are potential tax options to consider, for example, reducing this amount over a period of years that can reduce the amount that's immediately charged to capital gains. There were annual allowances, which obviously were a lot more favourable than they are at this point in time, which is a bit of a shame and takes a lot longer now to dispose of the asset in that trust or the gain in that trust, really, but it's still an option.
Some of the other practicalities associated with the trust. Now, I understand that compared to companies, they're quite private, but can you summarise the trust registration service and how that operates? That's come into play in the last few years.
Yes, yeah, and I suppose if this is not an income accruing trust, it does have to be registered and there's a procedure to go through. It's broadly consists of giving details of those that have created the trust and names of and addresses for the trustees and beneficiaries. But other than that, there's not much reporting requirements required. I believe there is a public access that can allow access to these trusts, but you need to know about them and understand why they are, and you do question why anyone would independently want to go and look to see what this trust consists of, really, or who the trustees of it are. The trust registration only really needs to be updated in these instances if there are a change of trustees, or if the structure of the trust changes. So if it did then become subject to income tax because there was income accruing within it, or capital disposals that need to be declared, obviously tax returns are needed. If this trust does hold assets accruing income, then again, the similar trust registration process, but you obtain a different type of reference, which is then used to essentially to then deal with your annual tax returns.
And would that be something that an accountant would help with, or can the trustees do it themselves?
Again, trustees can. There are some complexities, and the taxation of trusts is not a straightforward topic. I think we can all agree. But again, depending on what the income is and what the source of it is, certain clients would definitely be able to do it themselves.
I suppose they may have been preparing tax returns if they had been letting out the property before it going into the trust, so they may have a good sense of what needs to be declared and information to be set aside for the reporting process.
Yeah, exactly that.
That's good. And if we're dealing with the transfer of a property into the names of trustees, how is that done? Is presumably a land registry document needs to be prepared as well?
Normally, yes. Yes, it's the cleanest and the most straightforward way to deal with it. It ensures that the title to those trust assets is in the correct names, and it is something to be conscious of as and when time goes on. Trustees can change.
Yeah.
It's a reasonably straightforward mechanism to update the land registry and make sure that the trustees are the right individuals. I've always advised it, because I think we've seen it before where failure to update trustees can leave it. You see some of these trusts from the 1980s where they may have failed to update the title, and it can cause a headache. Yes, yeah.
Especially when there's suddenly a decision to sell the property.
Exactly, yes. It's always rather urgent at that point, isn't it? Yes. Yeah.
And you mentioned changing trustees. So if someone is appointed as a trustee, they have the option to step down. How would that be recorded?
Just a nice straightforward deed of retirement if there are other trustees. I always agree. I believe it's a decision that's useful to be had with all the trustees collectively. And at the end of the day, if we're signing the deed, they do need to sign it, everybody. But to have these conversations and think about the long-term succession is always somewhat useful. And maybe one trustee is retiring, we can do a straightforward deed of appointment and retirement to change the trustees and maybe bring in the next generation.
Good idea. We've talked about the pool of beneficiaries. How do the trustees know what the donor wanted them to do in the first place, and how to benefit those beneficiaries? Presumably some sort of guidance is needed.
Absolutely, yes. And this is where letters of wishes in particular are arguably as if not more important than the actual settlement deed itself. The settlement deed is the mechanism to create the trust, but it's all rather vanilla legalities, legalese. The letter of wishes is the bespoke document that reaffirms what the settlers, as they're referred to, want with this settlement.
And that's a private document.
Very much private. So yes, it's private and confidential to the trustees, and is essentially there as an aid to them to show what the intention was and the aims and objectives for this trust. So it's very, very useful document. And not so much, I suppose, when the settlers are around and they're living, they can obviously express an opinion. If capacity was lost or following their deaths and these trusts continue, obviously they've got 125 years in total normally. Without them there to be present to explain what they're intending, is having this letter of wishes is particularly helpful, just to set out what the aim was when the people that created it aren't there to explain it themselves.
Very true. And just to round up, can you remind us how you can actually close down one of these trusts?
Well, it's about clearing the assets, essentially, yeah. So again, there are tax implications to think about here, and like with everything, there are at times complications, and obviously tax is one of those to think about. But the trustees are there to make these decisions, and if the time is right to end this trust, they can terminate it, whether that be via a sale or a distribution of such assets. And once the formal notifications and documentation of ending that trust is established, that's essentially that. I suppose secondary jobs, for example, and notifying that the trust has ended on the trust registration services one, normally recommend some formal documentation just to reaffirm that the trust has ended, whether that's by a resolution or some type of deed. Is again just as having the evidence there and available, and again just making sure it's reported to the revenue, and HMRC are happy that any tax due has been paid.
One final point on tax is the fact that trusts have to pay tax every 10 years. It seems in many cases that's perhaps more tax efficient to pay a lower rate every 10 years rather than have one big hit when the original owner dies.
Absolutely that. And obviously for lack of a better word, we can crunch some numbers on this at times, and it's always worth thinking in the rounder estate planning, which I appreciate this topic today isn't about, but these type of trusts we often consider when we're doing formal estate planning for clients. As you say, there is this 10-yearly charge. Again, it depends on the value of the asset being added. If it's married couple, joint settlers, we've got this £650,000 allowance, and broadly every 10 years you're looking at a 6% charge on the value of the assets in excess of that £650,000 sum, or £325,000 if it's a single individual creating this trust.
As opposed to 40% on death.
Exactly that, as opposed to 40% that would be paid on death.
So just to summarise, these would be helpful where you've got a family with perhaps one valuable asset with some gains, and you want to start gifting but perhaps not hand it over immediately. Would that be a fair assessment?
Yeah, absolutely that. They are great for asset protection. Allows the parents normally to keep control of these assets and make sure that they're looked after and cared for and not wasted. But at the same time, there is some useful tax planning available with them.
Well, thank you very much, Ben. That's something that we can certainly talk to our clients about. And we've got lots of examples using second homes, whether it's a flat, a holiday home, or perhaps a block of shares that are laden with gains, and a chance to spread them out amongst the rest of the family. But thank you, it's been very informative.
Thank you.
That's all for today's episode of Listen Without Prejudice. Whether you're navigating a property transaction, a corporate, commercial, or family matter, we're here to guide you every step of the way. If you enjoyed the episode, don't forget to subscribe to stay up to date on future episodes, where we'll continue to explore the latest trends and challenges across our core practice areas. Do you have a question or topics you'd like us to cover? Or do you want to reach one of our experts? Feel free to get in touch via LinkedIn or through our website, bishopandsewell.co.uk. Thanks again for tuning in. Be sure to join us in our next episode, where the conversation continues. Until then, take care.